A Random Walk Down Wall Street by Burton G. Malkiel is a classic book that explores the principles of investing and offers insights into the financial markets. Published in 1973 and subsequently updated in several editions, this book has become a foundational text for both novice and experienced investors. The central theme of the book is the concept of the random walk, which suggests that stock prices move randomly and are unpredictable in the short term. Here is a concise summary of the key ideas and concepts presented in the book. 1. Efficient Market Hypothesis, EMH. Malkiel introduces the concept of the efficient market hypothesis, which argues that financial markets are highly efficient and that all available information is already reflected in stock prices. This idea implies that it is virtually impossible to consistently outperform the market through stock picking or market timing since prices adjust rapidly to new information. 2. Random walk theory. Malkiel popularizes the idea that stock prices follow a random walk, meaning that their movements are essentially unpredictable and resemble a series of random steps. He argues that trying to predict short-term price movements is akin to trying to predict the outcome of a coin toss. 3. Technical analysis. Malkiel critiques technical analysis, which involves using past price and volume data to predict future price movements. He argues that it is not a reliable method for making investment decisions. 4. Fundamental analysis. Fundamental analysis, which involves analyzing a company's financial health and prospects, is explored as a more sensible approach for long-term investors. However, Malkiel points out that even fundamental analysis has limitations due to the efficient market's ability to quickly incorporate new information into stock prices. 5. Asset allocation. The book emphasizes the importance of asset allocation, which involves diversifying investments across different asset classes, example, stocks, bonds, real estate, to reduce risk. Malkiel advises investors to determine their risk tolerance and financial goals before deciding on an appropriate asset allocation strategy. 6. Passive investing. Malkiel is a proponent of passive investing, particularly through the use of index funds or exchange-traded funds, ETFs. These investment vehicles aim to replicate the performance of an entire market or asset class. He argues that passive investing is a cost-effective way to capture broad market returns and is often superior to actively managed funds. 7. Market bubbles and behavioral finance. The book discusses market bubbles, such as the dot-com bubble and the housing bubble, and attributes them to irrational exuberance and herd behavior among investors. Behavioral finance concepts, like overconfidence, loss aversion, and confirmation bias, are explored to explain why investors often make suboptimal decisions. 8. Long-term investing. Malkiel encourages investors to adopt a long-term perspective and not be swayed by short-term market fluctuations. He highlights the power of compounding and the benefits of staying invested through market ups and downs. 9. Risk management. The book stresses the importance of risk management in investment. Diversification and the use of bonds are presented as tools to reduce portfolio risk. Malkiel discusses strategies like dollar-cost averaging, which involves consistently investing a fixed amount of money over time to mitigate the impact of market volatility. 10. Retirement planning. Malkiel provides advice on retirement planning, including the importance of saving early and regularly, as well as making prudent investment choices to ensure a comfortable retirement. 11. Critiques of the book. While the book provides valuable insights, critics argue that the efficient market hypothesis may not hold in all situations, and there can be opportunities for skilled investors to outperform the market. In summary, A Random Walk Down Wall Street by Burton G. Malkiel offers a comprehensive overview of investment principles, emphasizing the efficiency of financial markets and advocating for a passive, long-term approach to investing. It serves as a valuable resource for investors seeking to navigate the complexities of the stock market and make informed decisions about their financial future. However, readers should also be aware of ongoing debates about the efficiency of markets and consider various investment strategies in their financial planning.